The unusual policies issued by the Fed are causing a twofold inflation problem in the real economy. We bet many of you on the other side of the screen could already notice how prices are surging in some goods, and you haven't seen it wrong. The sanitary outbreak reshaped our necessities, changing it according to our new reality. Some things that we used to frequently buy are not so much a part of our new routines as they used to be, being replaced by other products that are better adapted to the moment we're now living. For instance, previously many people used to drive to work. Today, however, considering they are still employed and working from home, like me, they don't feel like they need to spend so much on gas. But maybe, if they got time on their hands, they wanted to buy a new bike to teach their kids how to ride, and were caught by surprise when they saw a serious spike in prices. In this connection, a recent study has shown that prices are considerably increasing for the stuff we really want to buy, while those that have been left out of the picture are facing a decline in prices, thereby showing that inflation has already started to show significant impacts on the real economy. That is why today we're going to analyze the implications of this effect so that we can understand how it was formed and what we can expect inflation-wise over the next developments of the economic collapse. So stay with us, and please give this video a thumbs up, share it with your friends, and subscribe to our channel to keep updated on the most diverse economic topics that are building the historical moment we're living in. Last month, the Fed revealed its new flexible average inflation targeting FAIT or FAIT paradigm, which indicates the institution expects rates to be at zero at least until 2023, according to the latest FOMC projections. Although the measures still lack strict forward guidance and operational parameters, such as setting the target inflation, forecasting the look-back period, or for how long the overshoot would last. With that appeared two technical problems. For the Fed's AIT program to work, inflation would have to be low enough that even if it grows above 2% long-term target, the overshoot would still be controllable without re-emerging for a while. By contrast, it seems at this point that even official readings of both goods and wage inflation are starting to considerably climb up, and that would probably threaten the Fed's inflation overshoot target by 2021. Examining Nordea's Andreas Steno-Larsen's outlook about what the Fed has said so far concerning AIT, it is possible to recognize how there has been an intentional absence of clarity coming from Jay Powell. However, other members of the FOMC committee who have lower profiles managed to be much more assertive and clear in their communication. In particular, Robert Kaplan, who has stated he could support a rise if inflation hits 2.275 to 2.350%, while Kashkari has specified that interest rates will be maintained at current levels until inflation breaks above 2% in 12 consecutive months. Most remarkably, last week, Chicago Fed's Evans signaled that a rate spike could possibly be issued before the 2% rate gets disrupted, in case the Fed felt confident enough with the inflation prospects. In this manner, the problem will surface depending on where one looks. Circling back to our initial argument that many U.S. consumers are witnessing price surges in the items they're consuming the most, the increased rate in prices is already either at or above the Fed's inflation overshoot targets. Correspondingly, Wall Street Journal's James McIntosh published an article over the weekend titled "Inflation is Already Here for the Stuff You Actually Want to Buy," which sharply evaluated the situation. McIntosh described that if it feels like the price of everything you buy has been soaring, that's because it has. even as central bankers everywhere worry about the danger of deflation. The author then highlights to the massive gap between the everyday experience and the annual inflation rate of 1.3%, observing that the price of stuff we're buying is rising much faster, while the stuff we're no longer buying has been falling, but still counts for the figures. Evidently, this adds up perfectly, because in essence, the higher the demand for a given good or service, the higher price will escalate, and vice versa. Just as we can see in this chart, the data transcribe that in this post-health crisis era, where people are now working from home, the annual inflation for some products is now considerably overshooting the Fed's targets. Starting with the cost of homemade meals, since it's where the biggest part of the population is spending their time, noticing an increase of 4.6% in August compared with a year earlier, which is considered the biggest rise in roughly a decade. On the other hand, in empty school and workplace cafeterias, food is now 3% cheaper. Even knowing that food prices are typically more volatile than for other products, it's important to outline that the tendency hasn't been restricted to it. In fact, the exact same pattern is appearing for many other items that are sensitive to our routine change in face of the sanitary crisis implications. Since now, many of us are working from home, yes, me included, there isn't much necessity to purchase a new suit or dress, which are down 17%, makeup down 3%, hotel rooms down 13%, or air tickets down 23%. Meanwhile, our new habits boosted sharp price increases in other products. For instance, if you're sitting at home in your pajamas, like me, know that men's nightwear went up 4%. If you cycle more often now, bikes are up 6%, or read more for pleasure, books are up 4%, and newspapers up 5%. And as people are now trying to craft and develop their hobbies and skills, items such as sewing machines and fabric went up 9%, and cameras were up 4%. Also, medical care is in demand, going up 5%, while higher education seems much less attractive, with tuition fees going up 1.3%. The change in buying habits have also enhanced a central aspect of the current inflation-deflation discussion. That is to say, the way inflation is officially measured, emphasizing the difference between the Consumer Price Index, CPI, and the Personal Consumption Expenditures Price Index, PCE. The WSJ article draws our attention to the fact that CPI captures the headlines and determines the return on inflation-linked treasuries, or TIPS. But the Feds have been using PCE, and the two indexes were divergent during the summer. CPI is evaluated according to spending patterns that were set a couple of years ago, while PCE recalculates spending every month. The most recent PCE data goes back to July, and it showed a rebound in prices, which rose 0.4% over 3 months compared with the prior 3 months on an annualized basis. However, CPI was still demonstrating prices falling on the same basis, even though in August the reopening of the economy pushed 3-month annualized CPI inflation above 3%. And according to McIntosh's prognosis, the PCE will be even higher for August, given its calculation method. Furthermore, the Financial Times also reported that the U.S. consumer prices increased for a third consecutive month, and the inflation continues to rise on the back of the slight economic upturn from the worst phase of the sanitary outbreak. Analyzing the August data released by the U.S. Bureau of Labor Statistics after the Fed's decision to shift to an average inflation target, allowing for periods of higher inflation to support the economy, the figures showed the Consumer Price Index rising by a seasonably adjusted 0.4% last month compared with July, topping economists' average forecast of a 0.3% gain. Core CPI, which strips out volatile food and energy prices, registered an annual rise of 1.7% in August, its highest level since the health crisis began. While economists said the rebound in inflation was evidence of the recovery's progress, they cautioned that the price gains may not last, since they were partially driven by inventory shortages, published the journal. Also, the report recalled that the U.S. economy is still suffering from weak demand with high unemployment and lots of slack in the labor market. And even though Fed's agents have strongly affirmed they are not anticipating the Fed to lift off from the effective lower bound of interest rates at zero until mid-2024, the FT report demonstrated that the CPI had already been up 0.6% in June and July. It slipped 0.8% in April during the height of the shutdowns, which is the biggest drop since December 2008. In that way, affirming that the Fed inflation shift is raising questions about past rate rises. Moreover, the report also indicated that last month, a substantial price rise was seen across a broad range of categories. According to the Bureau of Labor Statistics data, some of the products in which prices have soared were used cars and trucks, which recorded a 5.4% jump in prices and were the main driver, pardon the pun, of the month's advance. Indices for petrol, shelter, recreation, and household furnishings and operations also contributed. Food prices ticked 0.1% higher after falling in July. Prices for eating out climbed, offsetting declines in foods for the home that posted sharp increases during the shutdowns. Additionally, the BLS figures published last Thursday show that on a month-to-month basis, core CPI went up 0.4% month-to-month, which was stronger than the 0.2% rise forecasted by economists in a Reuters poll. The rate excludes volatile food and energy prices, of course, which means it refers to other goods that used to have steady rates before the whole meltdown started. Likewise, the report registered prices that businesses receive for their products and services also rose more than expected in August. The Producer Price Index was up 0.3% against the previous month, compared with economists' forecast for 0.2% growth and following a 0.6% jump in July. With all that said, another reason why prices have surged recently is related to the fact that the global health crisis has created inflationary pressure by restricting supply, which happened exactly when the demand increased. At the same time, the outbreak sparked even more turbulence in the ongoing U.S.-China trade war, intensifying the trend toward deglobalization, which means supply could be constrained for a long time, especially considering that the existing global supply chains are already severely damaged. Even so, many economists are confident that the prevalent food prices over the next 1 to 2 years will be mostly deflationary in the face of the massive layoffs that considerably crushed wages. In the short term, the demand shock prevails, so we will have subdued prices for the next 12 to 18 months, says Luigi Speranza, chief global economist at BNP Paribas. That is to say, the lingering effects from the health crisis could be translated into less need for travel and tourism workers for years to come, while those who have been unemployed will lose skills. Also, the deflationary side effects of the forthcoming macro transformations can create a surge of delinquencies and defaults across commercial properties, possibly leading to a widespread deflationary debt destruction, as many workers will be forced to leave to find new roles. In conclusion, if Congress doesn't manage to find an agreement about a fifth fiscal stimulus, the price rises are likely to continue to grow at a fast pace. worrying investors and triggering warning signs for the economy, particularly if the second wave of viral cases is followed by a third, boosting layoffs and a recession once again, ultimately also affecting prices. So, the prospects from now on seem to include soaring prices for the things Americans need and declining prices for the things they don't. For the major institutions, this isn't enough to raise their attention. But for us, my friend, the average Americans on Main Street, it means more financial pain ahead.